briefly set out the rationale for the decisions of the MPC. The MPC noted that the headline inflation has eased significantly and is likely to be softer than the earlier projections. This is primarily on account of the exceptionally benign food prices. Reflecting these favorable conditions, the projections for average headline inflation this year and Q1 next year have been further revised downwards. Core inflation, which had been rising steadily since Q1 last year, eased at the margin in Q2 this year and is expected to remain anchored in the period ahead. So both headline and core inflation are expected to be at or below the 4% mark during the first half of next year. In fact, the underlying inflation pressures are even lower, as the impact of increased prices of precious metals in this inflation number is about 50 basis points. Growth, while remaining resilient, is expected to soften somewhat. Thus, the growth-inflation balance, especially the benign inflation outlook on both headline and core, continues to provide the policy space to support the growth momentum. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 5.25%, and the MPC also decided to continue with the neutral stance. I will now spell out in some detail our assessment of growth and inflation. First of all, growth. Real GDP registered a six-quarter high growth of 8.2%, as you are all aware, in Q2. This is underpinned by resilient domestic demand amidst global trade and policy uncertainties. On the supply side, real GVA expanded by 8.1%, aided by buoyant industrial and services sectors. Economic activity during the first half of the financial year benefited from income tax and GST rationalization, softer crude oil prices, front-loading of government capital expenditure, and facilitative monetary and financial conditions supported by benign inflation. High-frequency indicators suggest that domestic economic activity is holding up in Q3. There are some signs of weakness in few leading indicators. GST rationalization and festival-related spending supported domestic demand during October-November this year. Rural demand continues to be robust. Urban demand is recovering steadily. Investment activity remains healthy, with private investment gaining steam on the back of expansion in non-food bank credit and high capacity utilization, which is of the order of about 75%. Merchandise exports declined in October amid subdued external demand, accompanied by softer services exports. On the supply side, agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi crop sowing. Manufacturing activity continues to improve, while the services sector is maintaining a steady pace. Looking ahead, domestic factors such as healthy agricultural prospects, continued impact of GST rationalization, benign inflation, healthy balance sheets of corporates and financial institutions, congenial monetary and financial conditions should continue to support economic activity. Continuing reform initiatives, moreover, would further facilitate growth. On the external front, services exports are likely to remain strong, while merchandise exports face some headwinds. External uncertainties continue to pose downside risks to the outlook, while speedy conclusion of various ongoing trade and investment negotiations which the government is undertaking with various countries and jurisdictions, present upside potential. Taking all these factors into consideration, real GDP growth for this year is now projected at 7.3%. This is up by about 0.5% from our earlier projections. Q3 is projected at 7% and Q4 at 6.5%. Real GDP growth for Q1 next year is projected at 6.7% and Q2 next year at 6.8%. The risks are evenly balanced. I will now move to inflation.